Investing in exchange-traded funds, ETFs, has become increasingly popular among both seasoned investors and newcomers to the world of finance. ETFs offer a diversified and cost-effective way to invest in various assets, such as stocks or bonds. However, with a plethora of ETF options available, it can be challenging to select the right one for your investment goals. In this article, we'll delve into a detailed comparison of two prominent ETFs, Vanguard Total Stock Market ETF, VTI, and Vanguard High Dividend Yield ETF, VYM, to help you make an informed decision on where to allocate your hard-earned money. VTI, Vanguard Total Stock Market ETF. VYM, Vanguard High Dividend Yield ETF. Before we dive into the comparison, it's essential to understand the characteristics of each ETF. VTI, or Vanguard Total Stock Market ETF, is designed to track the performance of the CRSP US Total Market Index. It aims to provide exposure to the entire U.S. equity market, encompassing a wide range of companies, from large-cap giants to small-cap up-and-comers. VYM, or Vanguard High Dividend Yield ETF, seeks to replicate the performance of the FTSE High Dividend Yield Index. This ETF focuses on companies with a history of paying high dividends and may be appealing to investors seeking income from their investments. Now, let's explore these two ETFs in greater detail. Investment objectives. VTI primarily targets broad market exposure. Its primary goal is to capture the overall performance of the U.S. stock market, making it a suitable choice for investors who seek long-term growth and diversification. With VTI, you essentially own a piece of every publicly traded company in the U.S., making it a comprehensive investment option. On the other hand, VYM is tailored for investors looking for dividend income. It selects and holds stocks of companies known for consistently paying dividends, typically large-cap, stable corporations. VYM provides an opportunity for investors to receive regular income through dividend payments, making it an attractive choice for those in or nearing retirement. Diversification. Diversification is a key factor in risk management and portfolio performance. VTI is one of the most diversified ETFs available, as it includes over 3,600 individual stocks that cover a broad spectrum of industries and sectors. This means that when you invest in VTI, you're spreading your risk across a wide range of companies, reducing your exposure to the performance of any single stock or industry. VYM, while still diversified, is naturally more concentrated than VTI due to its focus on high dividend-yielding stocks. This ETF typically holds around 400 to 500 stocks, primarily from the consumer staples, healthcare, and financial sectors. This concentration can lead to a higher level of risk if the companies in those sectors face challenges. Risk and volatility. Due to its broad market exposure, VTI tends to be less volatile than VYM. Its diversification across various industries and market segments makes it more resilient to economic downturns and market fluctuations. Investors in VTI can expect smoother, long-term growth with lower short-term volatility. VYM, on the other hand, has a higher yield due to its focus on dividend-paying stocks, which can make it more attractive to income-oriented investors. However, this emphasis on income can sometimes come at the cost of increased volatility. Companies that pay high dividends might face pressure to maintain those payments, potentially leading to stock price fluctuations. Performance and returns. Performance is a critical consideration for investors. When comparing VTI and VYM in terms of historical returns, it's essential to understand that these ETFs have different objectives. VTI aims for long-term growth by tracking the overall stock market, while VYM targets income through dividends. Historically, VTI has delivered solid returns over extended periods, especially during bullish markets. However, it can also experience more significant losses during market downturns due to its broad market exposure. VYM, on the other hand, may not provide the same level of capital appreciation as VTI during strong market rallies. Still, it can be an attractive option for those seeking consistent income, particularly in retirement. It's worth noting that the performance of both ETFs can be affected by changes in interest rates, economic conditions, and market sentiment. Therefore, investors should carefully assess their own financial goals and risk tolerance before choosing between VTI and VYM. Dividend yields. One of the primary features that differentiate VYM from VTI is its focus on high dividend yields. VYM typically offers a more generous dividend yield compared to VTI, making it a popular choice for income-seeking investors. VYM's dividend yield is based on the dividends paid by the underlying stocks in the ETF's portfolio. The companies included in VYM's holdings tend to have a history of consistent dividend payments, making it an attractive option for those looking for income, such as retirees. VTI, on the other hand, offers a dividend yield that is generally lower than VYM. This is because VTI focuses on tracking the overall stock market, and not all companies in its portfolio are necessarily high dividend payers. Tax considerations. Taxes can significantly impact an investor's returns, and the tax treatment of dividends can vary between VTI and VYM. VYM's focus on high dividend-yielding stocks means that a significant portion of the returns from this ETF comes in the form of qualified dividends. Qualified dividends typically receive favorable tax treatment, often taxed at a lower rate than ordinary income. VTI, being a more broadly diversified ETF, includes a mix of dividend-paying and non-dividend-paying stocks. As a result, VTI's dividend income may be taxed at different rates, depending on the nature of the dividends received. Investors should consult with a tax advisor or accountant to fully understand the tax implications of investing in these ETFs and how it aligns with their overall tax strategy. Expense ratios. Expense ratios are an important consideration for ETF investors, as they impact the cost of owning the fund. A lower expense ratio means that a larger portion of your investment returns remains in your pocket. Both VTI and VYM are known for their low expense ratios, reflecting Vanguard's commitment to offering cost-effective investment options. However, there are slight differences in their expense ratios. VTI, as of the last available data, VTI had an expense ratio of 0.03%. This means that for every $10,000 you invest in VTI, you would pay $3 in annual fees. VTI's exceptionally low expense ratio makes it one of the most cost-effective ways to gain exposure to the entire U.S. stock market. VYM's expense ratio, as of the same data, was slightly higher at 0.06%. While still relatively low, it is double the expense ratio of VTI. This reflects the additional costs associated with managing an ETF that focuses on dividend-paying stocks. It's important to note that expense ratios can have a compounding effect on your returns over time. Therefore, investors who prioritize low fees may lean towards VTI. Liquidity and trading volume. Liquidity and trading volume are crucial factors to consider when investing in ETFs. Highly liquid ETFs tend to have narrower bid-ask spreads, meaning you can buy or sell shares closer to their net asset value, NAV. They also tend to have higher trading volumes, which ensures that you can execute your trades without significantly affecting the market price. VTI is one of the most liquid and heavily traded ETFs in the market. It boasts high trading volumes and narrow bid-ask spreads, making it an excellent choice for investors who value liquidity and cost-efficient trading. VYM also has a reasonable level of liquidity, but it may not be as liquid as VTI due to its focus on dividend-paying stocks. It's still considered highly tradable by most standards, but investors who prioritize liquidity above all else might prefer VTI. Sector exposure. VTI's goal is to provide broad market exposure, so it includes companies from all sectors of the economy. As a result, the sector exposure of VTI is representative of the entire U.S. stock market. This diversification can be a benefit as it helps to spread risk across various industries. VYM, on the other hand, tends to have a sector concentration in areas that traditionally pay high dividends. These sectors often include consumer staples, healthcare, and financials. While VYM does provide some diversification, it may not be as well diversified across sectors as VTI. When selecting between VTI and VYM, consider your overall portfolio and whether you already have exposure to certain sectors. Depending on your existing investments, you may choose an ETF that complements your portfolio's sector allocation. Investment strategy. VTI and VYM have different investment strategies that align with their respective objectives. Understanding these strategies is essential for making an informed investment decision. VTI's strategy is simple. It aims to replicate the performance of the CRSP US Total Market Index, which includes nearly all publicly traded U.S. companies. This strategy is rooted in the belief that, over the long term, the U.S. stock market tends to grow, and it provides broad diversification for investors. VYM follows the FTSE High Dividend Yield Index, which selects stocks of companies with high dividend yields. The strategy here is to target companies that have a history of returning profits to shareholders in the form of dividends. While this focus on dividends can provide a steady income stream, it may limit VYM's exposure to high-growth companies that reinvest their profits. Investors should align their choice of ETF with their own investment strategy and goals. If you're looking for growth and diversification, VTI may be more suitable. If you're seeking income, especially in retirement, VYM might be the better option. Dividend growth versus dividend yield. Investors should also consider the difference between dividend growth and dividend yield when choosing between VTI and VYM. VYM focuses on high dividend yield, which means it includes companies with a history of paying substantial dividends relative to their stock price. These companies often have stable cash flows and may be more mature, established firms. This can be appealing to income-oriented investors, as high yields can provide a reliable source of income. VTI, on the other hand, aims to capture the entire market, including companies with varying dividend policies. While VTI may include companies with lower dividend yields, it also encompasses high-growth firms that reinvest their profits for future expansion. This approach can lead to the potential for greater capital appreciation, but it might result in a lower current yield. Investors should decide whether they prioritize current income, dividend yield, or potential long-term growth, dividend growth, in their portfolio when choosing between these ETFs. Risk-return profile. Your risk tolerance and return expectations are significant factors when deciding between VTI and VYM. VTI, with its broad market exposure, offers a balanced risk-return profile. It can provide long-term capital appreciation, but its diversification also makes it relatively resilient to market volatility. This makes VTI suitable for investors with a moderate risk tolerance looking for steady, long-term growth. VYM, due to its focus on high dividend-yielding stocks, may appeal more to investors with a lower risk tolerance seeking income and stability. The trade-off is that VYM may not offer the same level of capital appreciation as VTI, particularly during strong market upswings. Investors should carefully assess their own risk tolerance and return objectives to determine which ETF aligns better with their investment strategy. Liquidity and tax efficiency. The liquidity of an ETF can affect the ease of buying and selling shares. Both VTI and VYM are well-established, liquid ETFs, but VTI typically has higher trading volume and narrower spreads due to its broader market focus. Tax efficiency is another crucial consideration, particularly for taxable accounts. VYM's emphasis on high dividend stocks means that it often distributes taxable income to shareholders. This can result in tax consequences for investors, depending on their tax bracket and the accounts in which they hold the ETF. VTI's broader diversification may lead to a more tax-efficient experience for investors, as it includes both dividend-paying and growth-oriented stocks. However, the tax implications can vary depending on individual circumstances and the specific account types in which you hold the ETF. Investors should consult with tax advisors and consider the implications of liquidity and tax efficiency when making their choice between VTI and VYM. Income needs and investment horizon. Your income needs and investment horizon play a critical role in determining which ETF is the right fit for your portfolio. If you're an income-oriented investor, such as a retiree, and your primary objective is to generate consistent cash flow from your investments, VYM may be a more suitable choice. Its focus on high dividend-yielding stocks can provide a steady income stream to support your financial needs. Alternatively, if you have a longer investment horizon and are looking for overall portfolio growth, VTI may be a better option. The broad market exposure it offers can help you capture the potential for long-term capital appreciation, which may be important if you have many years before retirement. Ultimately, your investment goals and time frame will guide your choice between VTI and VYM. Dividend growth versus capital appreciation. Another important distinction between VTI and VYM is the focus on dividend growth versus capital appreciation. VYM prioritizes dividend growth by investing in companies with a history of paying substantial dividends. While this can provide a steady income stream, it may not offer the same potential for capital appreciation as VTI. VTI, with its broad market exposure, aims to capture the growth potential of the overall U.S. stock market. It includes not only dividend-paying stocks but also high-growth companies that reinvest their profits for expansion. This approach can result in higher capital appreciation over the long term, making VTI an attractive option for investors looking for both growth and income. Investors should assess their preference for dividend growth or capital appreciation when making a choice between VTI and VYM. Dollar cost averaging. Dollar cost averaging, DCA, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the ETF's price. This approach can help reduce the impact of market volatility and may be relevant to consider when choosing between VTI and VYM. VTI, with its broad market exposure, is well suited for dollar cost averaging because it offers diversified exposure to the entire U.S. stock market. When you invest regularly in VTI, you are buying a slice of the entire market, smoothing out the impact of market fluctuations on your portfolio. VYM, with its focus on dividend-paying stocks, may not be as ideal for dollar-cost averaging, as the prices of the individual stocks can vary, affecting your income and investment timing. Investors who intend to implement a DCA strategy may find VTI to be a more suitable choice due to its broad diversification and the ability to invest consistently in the overall U.S. stock market. Dividend reinvestment. Dividend reinvestment is a strategy where you use the dividends received from your investments to purchase additional shares of the same ETF. This can be an important consideration when comparing VTI and VYM. VYM's focus on high dividend yields makes it a natural fit for dividend reinvestment. The income generated from the dividends can be reinvested in the ETF, allowing you to compound your investment over time and potentially benefit from the power of compounding. VTI, while it does offer some dividends, may not be as conducive to a dividend reinvestment strategy, especially if your primary goal is to reinvest dividends for long-term growth. VTI's primary appeal lies in its broad market exposure, making it more suitable for those who want to capture the overall growth of the U.S. stock market. Tax-efficient investing. Tax-efficient investing is an essential consideration for maximizing your after-tax returns. The tax implications of VTI and VYM can differ, so it's crucial to understand how they align with your tax strategy. VYM tends to distribute taxable income to shareholders, primarily in the form of qualified dividends. Depending on your tax bracket and the type of accounts in which you hold VYM, this can result in tax consequences. It's essential to evaluate the impact of these tax implications on your overall tax strategy. VTI's broader diversification means that it may offer a more tax-efficient experience for investors. However, the tax consequences can vary depending on your specific circumstances and the types of accounts you use for your investments. Consult with a tax advisor to understand the tax implications of investing in VTI and VYM and how they align with your tax strategy. Asset allocation. Asset allocation is a fundamental aspect of constructing a well-balanced investment portfolio. When deciding between VTI and VYM, consider how each ETF fits into your overall asset allocation strategy. VTI, with its broad market exposure, can serve as a core holding in a diversified portfolio. It provides exposure to the entire U.S. stock market, making it suitable for the equity portion of your portfolio. VYM, with its focus on high dividend-yielding stocks, can be considered for the income or dividend-oriented portion of your portfolio. It complements a portfolio that aims to generate income or seek stability through dividends. Your overall asset allocation should align with your investment goals, risk tolerance, and time horizon. Carefully assess how VTI and VYM fit into your broader investment strategy. Conclusion. Choosing between Vanguard Total Stock Market ETF, VTI, and Vanguard High Dividend Yield ETF, VYM, requires a thorough understanding of your investment objectives, risk tolerance, and overall financial goals. Both ETFs offer distinct advantages, and your choice should align with your specific needs. VTI is an ideal option for investors seeking broad market exposure, diversification, and long-term growth. It offers a balanced risk-return profile and is well-suited for those with a longer investment horizon. VYM, on the other hand, is tailored for income-oriented investors, especially those in or nearing retirement. It provides an attractive dividend yield and focuses on companies with a history of consistent dividend payments. Consider your income needs, investment horizon, risk tolerance, and tax strategy when making your decision. Additionally, think about how each ETF fits into your asset allocation strategy and overall portfolio construction. Remember that there's no one-size-fits-all answer, and your choice should reflect your unique financial situation and goals. Before making any investment decision, it's advisable to consult with a financial advisor or conduct thorough research to ensure that your choice aligns with your specific circumstances and objectives.